Hello everybody, welcome to another upload here on the Rosie Murphy channel, and I'm hoping you'll find this one a little bit interesting today. One of the topics du jour in the world, of course, besides the coronavirus, is the impact on financial markets and particularly equities, i.e. stock prices and bond prices. We've seen that bond prices have gone through the roof. And as I'm recording this, the 10-year, you lend money to the government for 10 years today and you'll be returned with the handsome sum of 0.7%, well less than 1% per year return on that money that you lend, a all-time record low for lending. What does it bode for the future? Well, probably not great things, as we'll discuss in probably a future upload. But what I want to talk about today, one of the things that I've most enjoyed through many years is being a market historian and going back and looking at past periods of the market, tremendous bull markets, as well as hair-raising bear markets or declines. Of course, 1929, he's considered the grandpa of all, the grand poobah of all market crashes. It certainly got the most headlines, and it is generally related with kicking off the Great Depression, although academics still argue about that to this day. But there were other crashes too that took place, some pretty big ones. The Panic of 1907, when money tightened up, when an old-time corner on the market collapsed, and people were scrambling for money to borrow. And there was no Federal Reserve at that time, and interest rates shot through the roof as people had to pay extremely high rates of interest to get their hands on some money, and the result is it collapsed the market at that time. We also had the 2008 real estate crash. In the mid-1990s. We had the dot-com bubble burst, and in 1937 we had a significant decline too. But the important thing to take note is crashes vary in terms of their significance longer term for the economy. But one thing that seems to be rather is a pretty good relationship is the fact that the more swift and the more steep and the more prolonged the initial plunge of an equity like a stock market is, the more there tends to be serious economic disruption. And this is what may be happening now. People today aren't very well versed in the history of markets, and it's equivalent to floating on the ocean in a rowboat and having no idea where you're going or what to expect or what defines what points can you use to find your bearings. How can you navigate? The question I want to discuss today is how long do crashes, quote unquote, play out? Some people will define today as a crash as something is sometimes one day. Crude oil prices crashed today. They were down 10% on the market today, $4 a barrel. And in the scheme of things, yeah, percentage-wise, it's 10% in a day. That's a pretty stellar move. But significant crashes tend to play out over longer periods of time. And we might want to bear this in mind as we look at what I call the Corona crack up here in 2020. Believe it or not, what we're looking at now in the equity market, in the stock market, may be a long overdue and serious correction. Yes, you may find it hard to believe, even fathom, that from here the market could go up and make new all-time high. Well, interest rates are certainly favorable. There's not a lot of other investment opportunities out there. So why not? It could happen. That's the nature of the world that we live in and the nature of markets. Now, common sense tells us otherwise, though, and the likelihood of that happening is probably quite small. In fact, the likelihood is we have a serious situation that needs to play out, and it will play out over a period of weeks and weeks and perhaps a month or two. It will not have a rapid resolution. Remember, the psychology that winds up and gets people buying and investing changes over time. And the higher a market goes and the more invincible it becomes, the more people think, well, it'll just keep rising forever, so no big deal. We'll pour money, more and more money in. And unfortunately, you have that sort of upside down pyramid where the greatest money comes in at the highest prices. Why? Because people were attracted to the most at the end when it seemed like it was a no-lose proposition. That's it's one of the few places that straight out defies the laws of economics. And generally, the higher a price goes, the less people want to buy it, except when it comes to stocks. The higher stocks go, more people want to be aboard. Conversely, when stocks are very low and going lower and falling through the floor, and they're on sale, nobody wants to touch them. It's like they're on fire, right? They go begging and they drop and drop and drop and reach ridiculous fire sale levels. And the value becomes very low because nobody's interested in them. They're dead, even when you put them on sale. Very strange how an investment market is one of the few things you can run counter to the laws of economics. And therein lies the big tripwire that gets people in so much trouble. But let's not pull too much off the side with that interesting little element. Let's go back in history and see if indeed we are in some type of crash phenomena or in a severe bear market. Let's not even pay attention to the consequences of coronavirus, because we have oil prices that are, in free fall. They're going to be affecting the oil industry, which is a huge part of the market, the energy stocks and things like that. We have cruise ships, airline capacity is high, but the bookings are hitting an all-time low. There's all times of tremendous, quick contractures taking place in the economy. The emphasis is on quick. But when it comes to looking at our markets and looking at declines, we have to get the frame of mind to understand that if we are in something serious, which I believe that we could be here, then we have to expect the so-called crash phenomena to play out over a period of weeks. In 1907, it took about a year for the market from the peak till the real first initial shot, the real first meaningful bottom to be put in place. In 1929, the market hit its peak on September 6th. It didn't stop dropping at the end of September and then go on its way a month later. It didn't stop dropping 2 months later. Okay, at the end of October of 1929, it was still dropping until it hit November or early November of 1929. Okay, that's over 65 days of time. Well, we're in a phenomena where in February we were all excited about high prices, and here we are 4 weeks later. And we've dropped some 13% here. Some people think we're out of the woods. But in reality, if history is any guide, this just might be the first inning of a pretty sustained decline here that could go another month, well into March. And the strange things, too, is traditionally in history, a lot of bottoms from big panics, at least the first stage bottoms, have been found in the month of, well, you guessed it, in October of 1929 when the market crashed. It really didn't hit its absolute low until April of 1930, November, and then it reached its peak. Actually, it dropped into November 3rd and then rallied to April. So April tends to be a turning point either for up or down, so it's something worth bearing in mind in history. The whole point I'm trying to make is that things play out over time. It takes time for, although crashes may get some kind of noteworthiness because they seem to occur over short periods of time. They actually occur over a period of weeks and even months, because it takes a long time to get people's psychology turned around and get the last people really scared that they shouldn't be holding stocks. Okay, just a little bit of an interesting look back through history. Also, in the crash of 1937, the market peaked around in September, October 37. It also had a 50% drop at that point. Again, it's something that played out over a period of months. Well, thanks so much for watching today. I think you get the idea. Things don't happen as fast as they seem to be relayed in history, especially when it comes to things like crashes. Okay? Thanks so much for watching, everybody, and enjoy the rest of your day. And thumbs up are appreciated.